Good afternoon, everybody. Welcome to the Vermont State Senate Committee on Institutions. Today is April 27th, 2021. I am your host for this afternoon's events, Joe Benning, your chair of the committee. We also have with us committee member Senator Mazza from Grand Isle, Senator Ingalls from Essex Orleans, Senator McCormick from Windsor, and Senator Parent from Franklin County. We are continuing our conversations as the session for this committee winds down with getting some updates on various parts of how the capital bill is eventually put together. And today we have, to start off the batting order, Chris Roop is going to tell us all about the current information about pension plans. Pensions, for the edification of those watching on YouTube, have something to do with this committee's ability to make payments to the various organizations that come to us, because they are part of the process of what the treasurer goes through to figure out exactly how much we can bond for. So keeping the committee abreast of these kinds of external issues is important before we leave for the year. And Chris, that means I'm going to turn the floor over to you, and you can educate us on what you came to us with today.
Great. Thank you, Senator Benning. For the record, my name is Chris Roop, and I'm an analyst with the Joint Fiscal Office. I've had the great pleasure of spending some quality time with Senator Mazza and Senator Ingalls over in the Transportation Committee, but this is a new committee for me. So
wait. Let me say great.
Let everybody know which chair you prefer, okay, when we're all done.
At the very end, yeah. If we still
his
have
credibility,
time,
his credibility just went out the window when he said great time with you two guys.
Yeah. Have you ever gone sailing on a ship before? Don't go with Senator Benning.
Yeah.
We take you on a 3-hour tour. And by the way, we do like humor in this committee.
Bring your scuba gear.
Yeah,
that's great.
So welcome to Institutions, a better committee than Transportation.
Thank you very much. I'm going to go ahead and share my screen here. So I don't have a lot of slides today. I have my goal here was to really provide sort of a high level overview of about a dozen slides and leave some time for some questions for members of the public who may be viewing online, or members of the committee who would like to take a deeper dive into pension topics. I have done a series of presentations for the other body earlier this session, and those slides and the videos are available on the JFO website. So I could go on and on about pensions, but I'm going to try to stay out of the weeds too much today, because like I always say when I'm doing these things, I'm not a lawyer, an actuary, or an investment advisor. I'm a fiscal analyst for the legislature. Before I came here, though, I worked for the city of Philadelphia for quite a while. And one of my responsibilities down there was being a voting trustee on the city Board of Pensions and Retirement. So I did that for about 2.5 years. So I have a little bit of familiarity with how pensions work and sort of the ins and outs of it and some of the challenges that face states like Vermont. So let's just start off with a really quick overview of how the pension systems here in Vermont are governed. The state has 3 major pension systems, and they each have a board of trustees according to statute. Their memberships vary slightly, but the overall theme is that the employee representatives play a pretty significant role in the decision-making process. The 3 boards of trustees along the right side of this slide are tasked with the general administration and operation of the retirement systems and for adopting various actuarial recommendations. The trustee boards also play a role with choosing members to serve on VPIC, the Vermont Pension Investment Committee. VPIC is the body that oversees the investment and management of all the plan assets. And the treasurer serves on all of these boards, and they all must agree to changes to the assumed rate of return. But at all levels, members of the retirement system, the members themselves, sit at the decision-making tables and play a significant role in the governance of the retirement systems. So why are we talking about pensions so much this session? This slide summarizes the immediate issue at hand. Both the state employee and teacher pension systems are facing significant and growing unfunded liabilities. And as a reminder, the unfunded liability represents the gap between the value of the plan assets and the expected cost of the retirement benefits that have been earned by the active and retired workforce. Right now, VSERS is only 66.4% funded, and the teacher pension is 51.3% funded. The unfunded liability across these two systems is almost $3 billion. And that gap will ultimately need to be closed by the end of the amortization period in 2038. Most recently, the unfunded liabilities have increased by approximately $604 million from FY21 to FY22. And that increase caused the employer's required annual payment to the pension systems, called the ADAC, to increase by roughly $96 million this year compared to last year. And as a reminder, the ADAC payment is the amount the employer must pay in every year to fully fund the normal cost, plus make a payment toward that unfunded liability. So when the unfunded liability gets bigger, the ADAC payment gets bigger too. It works almost like a credit card. The balance on your card is the unfunded liability, and the ADAC is the amount you need to pay down that balance with interest. And these amounts are recalculated every year. So why did these numbers go up so much? It was due to a combination of factors. Economic assumptions were revised, including lowering the assumed rate of return from 7.5% to 7%. Demographic assumptions were also revised. And these revisions were prompted by the fact that in recent years, the demographic and economic experience of the plans has deviated quite a bit from the assumptions. And the assumptions for the future have changed. In other words, we did not consistently earn the investment return we thought we would in the past. And the future investment outlook looks less rosy than it looked in the past. The behavior of the workforce also differed from what was previously assumed, and forward-looking assumptions were revised to hopefully be more realistic in future years. So in the bigger picture, the state's long-term retirement liabilities have more than doubled since the current amortization period began in 2008. Right now, the total unfunded retirement liabilities, including pensions and OPEB, or subsidized retiree healthcare, amounts to more than $5.6 billion, or approximately $9,100 per Vermonter. Pension liabilities alone have increased more than sixfold, from $700 per Vermonter in 2008 to $4,800 per Vermonter today. And subsidized retiree healthcare, or OPEB, which we currently do not pre-fund, adds another $4,300 per Vermonter of unfunded liability to the state's balance sheet. The rating agencies look at factors like this when analyzing and determining state credit ratings, and these unfunded liabilities are not trending in a positive direction. As these unfunded liabilities have grown, they've added stress to the budget. The unfunded pension liability must ultimately be paid off, and it has grown much faster than the overall payroll or size of the active workforce has grown. As a result, costs related to pensions are eating a larger slice of the budget pie. In total, our retirement liabilities consume more than 13 cents of every general fund dollar, up from 10.5 cents 4 years ago. Pension costs now consume almost $200 million, or more than 10% of the general fund. And OPEB, that subsidized retiree healthcare, consumes an additional $50 million. Most of the general fund impact is related to the teacher retirement systems, because the general fund pays for the teacher OPEB and the unfunded teacher pension liability. VSERS retirement costs are allocated to the various funds that employ the active workforce. So only about 40% of the VSERS costs hits the general fund. So these liabilities and costs are substantial, but it's important to note that this was not always the case. When you go back 15 years before the Great Recession, both of those systems were close to fully funded. VSERS was actually 100% funded in 2007, and the teacher system was in the mid to high 80%. But since 2008, when the current amortization period started, future pension costs have grown faster than the pension assets have grown, and the costs have grown faster than the active payroll. As a result, the size of the gap between the asset and liability lines on the charts here, which is the unfunded liability, has grown. That unfunded liability represents the debt that ultimately needs to be addressed by the end of the amortization period, which is 2038. It's important to note that this gap has grown despite the legislature fully funding its required payments since 2007. But closing this growing gap will require higher ADAC payments in the future. Here you can see how steeply the pension payments have grown in recent years. The legislature has fully funded these growing ADACs every year since the start of the amortization period. and in some years paid excess amounts. But the funded ratio has still declined year after year. The hole has gotten deeper, thereby requiring higher payments in future years to make up the difference. As these pension costs have increased substantially, those costs have primarily fallen on the employer to pay. Employee contribution rates have not increased in recent years, and neither has the size of the active workforce. But the cost to the employer has increased significantly because the employer currently assumes the full risk when assumptions change or those assumptions are not met through experience. So if the systems miss their investment targets or their assumptions change, those additional costs fall on the employer to pay by default. And again, I want to stress that these recent increases are not related in any way, shape, or form to anyone underfunding the pension systems, because the employer has fully met its obligations every year during the amortization period. The charts on the right side of this slide focus just on the normal cost, which is the amount you need to pay to the pension fund every year to fund the future year's worth of benefits that the workforce accrued that year. Employee contributions fund a portion of the normal cost. They do not pay down the unfunded liability, which is the employer's responsibility. But in recent years, that normal cost has grown due to changes in assumptions, and as a result, employee contributions now cover roughly half of the normal cost. The other half of that cost, plus the payment toward the unfunded liability, are paid by the employer through that annual ADAC payment. So if everyone has been paying in their required amounts, why have the unfunded liabilities grown so much since 2008? The top chart shows you the impacts on both systems since 2008 and includes the impacts of the Great Recession. And the bottom chart shows you just what has happened since FY11 to exclude the impacts of the Great Recession. At the top here, you can see how the VSER system was once fully funded. Its unfunded liability was negative $11 million. The teacher system started the amortization period with an unfunded liability of roughly $275 million. A big reason why the teacher system had a higher starting unfunded liability was because the ADAC was fully funded during just 4 years between 1979 and 2006. And until 2014, teacher OPEB costs were paid out of the retirement system, which created additional unfunded liabilities. These things did not happen to the state employee system, but the ADACs have been fully funded for both systems throughout this amortization period. But if you add your way down these columns, you can see here how changes to assumptions, such as changing the assumed rate of return or changing your demographic assumptions, investment experience falling short of your assumptions, mainly your assumed rate of return, and demographic experiences deviating from assumptions have had on the growth of the unfunded liabilities over time. And to see just how big the impact of the Great Recession was, compare the investment experience totals in both charts. There are slides at the very end of this deck that break out these factors in greater detail, and that information was also included in a report that the Treasurer released on January 15th. And they're also in the most recent experience studies. So why did this experience deviate from assumptions so much? Well, both systems faced a lot of demographic changes right around the same time period that the funds were battered by the Great Recession. Both pension plans have matured quite a bit. That means that the number of retirees drawing benefits out of the system is increased a lot, while the number of active employees paying in has not increased so much. So the number of retirees on the VSER side has increased by approximately 63%. And the increase has been by 77% on the teacher side. Meanwhile, the size of that active workforce has not really grown on the state side, and it actually decreased on the teacher side. So overall, fewer people are paying in, and more people are getting paid out. Benefit payments out of those systems have grown faster than member contributions and now exceed payments made into the systems from the employer and from the members. This requires money to be taken out of the investment portfolio in order to fully fund retirement benefits every year, which makes it harder to make up ground and close that unfunded liability gap. The average retirement benefit has also grown, and it's around $21,000 a year. But a lot of this growth is due to the fact that we've seen so many more retirees entering the system at higher average salary rates than people who have been in retirement for longer periods of time. Here we see this dynamic play out in a slightly different way. The systems have seen positive income every year since 2009 from employee and employer contributions and from investment returns, with the exception of the investment losses in those Great Recession years. However, the amount paid out in benefits has steadily increased too, as more people have retired. This combination, which you can see on these charts, creates a headwind that slows the growth in the market value of assets from year to year and makes it harder for the systems to dig out of that hole and close that unfunded liability gap through investment gains. If you want to improve the funding ratio of the plans and close that unfunded liability, you need your asset growth to not just be positive. You need it to be higher than the growth rate of the pension liabilities. In other words, your money needs to grow faster than your expenses are growing, and that just has not been happening. My final chart shows you the big picture and speaks to the cost of inaction. If nothing changes, pension costs to the state will keep increasing between now and the end of the amortization period in order to dig out of that hole. We are looking at a combined total ADAC payments for VSERS and VSTRS of roughly $316 million in FY22, which is far higher than it was just a few years ago. This amount will grow to approximately $500 million by the end of the amortization period. And that's assuming that the hole doesn't get any deeper. In other words, we are assuming that all the assumptions are consistently met between now and then, and that current assumptions don't change. These costs are recalculated every year based on experience and will increase if assumptions are not met and decrease if assumptions are exceeded. But this is the status quo situation, assuming everything goes exactly as planned. And if we've learned anything from looking at the last decade, it should be that things rarely go exactly as planned. And there's always inherent risk that your costs will go up or go down. So the ADAC will keep crowding out other budgetary priorities in the future. And on top of that, failure to address the liabilities can also have negative impacts to the state's bond ratings, which can lead to additional fiscal pressures. When the rating agencies look at states, they consider things like their fiscal management, economic fundamentals, their demographics, their future growth projections, and the structural budgetary challenges facing the state, and the ability of the state to respond to those challenges and to respond to anything unforeseen. Vermont has already had its ratings outlook downgraded due in part to its growing retirement liabilities. And fortunately, the latest round of ratings has held steady. It does take decades of financial discipline to build and maintain strong bond ratings, and it can be lost very quickly, all of which should underline the importance of taking these liabilities seriously and ensuring that steps are taken to address them. So let's summarize everything on one slide. Since the Great Recession, the retirement liabilities have grown significantly and much faster than the plan assets have grown. Demographic pressures have had a lot to do with this. We've seen a very large growth in the number of retirees and the size of their benefits, though the state's pension benefits on average remain relatively modest. And this happened while the systems were trying to claw back from the impacts of the Great Recession. We've also seen the demographic experience of the workforce lead to higher than originally assumed costs. Changes were made to assumptions that will hopefully lower future risk to the plans, but they've also led to higher costs. As the number of retirees has grown, the systems are paying out more and more in benefits each year, more than employees and employers are contributing into the systems. And that requires assets to be pulled out of the investment portfolios to make up that difference. These factors all combine to just make it harder to dig out of the hole caused by the recession or to make rapid progress toward paying down the unfunded liability. They also increase the risk to the employer of higher ADAC payments when you don't hit your assumptions or the assumptions change. Overly optimistic investment assumptions and failure to meet those assumptions certainly contributed to the growth in unfunded liabilities, especially when you include the fact that the Great Recession occurred during this amortization period. Failure to consistently hit those assumptions, as well as lowering the assumptions for the future, both led to higher liabilities and higher ADAC costs. You hear a lot of people talk about the historic underfunding of the pensions, which mostly happened on the teacher side. Along with the old practice of paying for OPEB out of the teacher retirement systems, this did contribute to the cost of the ADAC and the fact that the teacher system has a lower funded ratio than the state system, which again was fully funded at the start of the amortization period. But this history did not lead to the enormous growth in liabilities from FY21 to FY22, or to the vast majority of the growth in the unfunded liability that happened since the start of the amortization period. Rather, the growth was mostly due to those other factors like investment performance, demographic experience, and changes to your assumptions. And like many other pension systems, the state systems lowered their assumed rate of return to 7% to more realistically match anticipated investment performance in the future. This might have the benefit of leading to less substantial deviations between experience and assumptions in the future, which would translate into lower risk of drastically higher ADAC payments from year to year. But this change certainly had a significant impact on increasingly unfunded liability and ADAC payments from FY21 to FY22. And it also lowered the funding ratio for both plans, because this change means that the plans expect to earn less from investment gains in the future, thereby requiring higher employer payments to make up the difference. So that's the end of my slide deck. If you have any other questions, I'd be happy to answer them now, or you can also feel free to send me an email at this address at your convenience. I've also added some additional slides at the very end of this deck that Denise can send around with some additional data. And I also have a link here that goes to much more longer and more detailed presentations I give on pensions this session. But I appreciate your attention and look forward to answering any questions that you may have.
So Chris, let me first thank you for putting together a pretty succinct set of PowerPoint presentations about what the problem is. I don't know if you can put a period on the end of this conversation yet, or want to stick your neck out that far, but last year, I spent quite a bit of time telling virtually every witness who was coming into our committee asking for money that there was a strong possibility the amount of money we were going to be able to bond for was going to be considerably less. Much to my surprise, the treasurer came back and gave us exactly the same thing we did last year. Are you able to say whether that may be different next year?
That's a great question. I think that really depends on what happens on the revenue front. And, you know, I think in all fronts, whether you're talking about pension investments or just the state of the economy in general, I think there's a great deal of uncertainty about what the next, 24 to 36 months could look like. In a status quo situation, if we always hit all of our assumptions, we always hit that assumed rate of return, the ADAC payments will increase by roughly 3% a year. And that's because of the way the statute is set up with our amortization schedule. So unlike your home mortgage, where you might pay the same amount every year for 30 years, we have what's called a level percent of payroll system, where you assume that payroll will grow by 3 or 3.5% a year, depending on the system. And the unfunded liability payments are structured so they increase at that same level. So the theory is that from year to year, it would not consume a greater share of the pie, and it would just grow with overall budget growth. Having said that, that all depends on you hitting your assumptions consistently and having no risk. So, it sounds like the investment performance is pretty good so far this year. It always comes out to how do things shake out on a fiscal year basis. And then we recognize our gains and losses. They're smoothed out over a 5-year period. So, you might have a rock star year in the stock market one year, but those gains are recognized 20% a year for the next 5 years. So, I think it's hard to say right now. I do think that these changes in assumptions will likely lead, are a little bit more conservative in nature, which means there's probably a little less risk of missing some of your assumptions from year to year. And one of the proposals that is before the legislature, it's currently it just passed out of the House last week, and it's now in Senate Government Operations, is to move what they call experience studies from a 5-year cycle to a 3-year cycle. Those experience studies are when the actuaries take a look at what happened in the fund, they reconcile it with your assumptions, and then they make a recommendation on whether or not your assumptions should change. The intent behind doing them a little bit more frequently is so you don't have as long of a time period where your experience might be lagging what you thought would happen. Because a big reason why we've seen these big jumps from year to year is because we did the experience studies, and then we did our valuation studies, assumptions were revised, and this was the result of those revised assumptions.
Were there changes in investment strategy that give you the impression now that we're doing a little better than we had in the previous few years?
Yeah, so that's a great question. This has come up a lot in the respective government operations committees, and the chair of VPIC has come in and testified, quite a few times. I think in recent years they've done a few things. They've moved to less expensive money managers. Right now that they have a very, very large percentage of the portfolio is indexed at pretty low fee funds. And the percentile of our performance relative to other comparable pension systems has increased pretty significantly. So, I haven't been around long enough to have the history of all these conversations around how the investment strategy has evolved, but they have certainly improved their performance in recent years compared to where we were maybe a decade ago, both relative to our peers and in terms of, just cutting your costs. Invest smarter, invest in less exotic high fee things that are not proven to sort of beat the overall market. But this is something that I think VPIC really focuses on very intentionally, because you want to hit your assumed rate of return consistently within an acceptable level of risk, the least amount of risk and volatility that you can possibly tolerate.
Okay. Senator Mazza.
That's great, Chris. That's just something explained to me. I can understand it. This is a great overview. Dave Coates is my neighbor, and he's been promoting defined pension plan. Is that not defined?
Defined contribution?
Yeah, contribution. Would you help me explain that?
Sure.
That seems to be around for a while, and what would that do?
Sure. So there's two big models out there in government. There's what, and including in these pension systems, sort of the dominant model is called a defined benefit, and it kind of sounds like it's what it kind of sounds like. Your retirement benefit is defined by a formula. So that formula is based on things like how long you've worked, how many years of service you have, what your benefit multiplier is, and what your average final compensation was. You plug all those factors in, and you can get an estimate of what your retirement benefit will be, in retirement. Defined contribution sort of flips that equation, where your benefit is really not defined by a formula. It's defined by how much money is in your account. So there will be a system where in a DC plan, which is more prevalent in the private sector, the employee may make a contribution to their retirement account out of their paycheck. It may be matched by the employer to some percentage. And then, your balance in your account when you retire determines what you'll have available for retirement. So the risk shakes out in a different way. So with a DB plan, the risk falls on the employer if your assumptions aren't met. In a DC plan, the risk falls on the employee. There's pros and cons to both models. They appeal to different segments of the workforce. Not a DB plan may appeal to somebody who might have a 30-year career horizon, which with the same employer, which is likely a little bit more common in the public sector than in the private sector. A DC plan probably offers you a little more portability. So if you might work from place to place, that allows you to sort of take your money from place to place. But it's at the end of the day, they function differently. The risk falls on the parties differently. And if you moved everybody over to a DC plan today, it would not solve this overall challenge. This unfunded liability represents the cost of really paying for the contractual obligations that the state has made with its active and retired workforce.
Thank you.
Are we
Senator
making,
McCormick.
are we making 7% now? Are we meeting our goals? Nobody's been able to tell us that.
So far this year, we're above 7%. And like I said, they reconcile this on a fiscal year basis. So what percentage you come out at is really sort of endpoint sensitive. It depends on what time period you're looking at. So for consistency, they look at it on a fiscal year basis and basically smooth out the volatility over a 5-year period. Because you might have a year where you do 12%, you might have a year where you do 2%. You don't want your budgetary issue, your budgetary contributions to fluctuate that much from year to year. So it's pretty common in plans to smooth that out over a period of time. We have not always been meeting our assumed rates of return. They've sometimes been higher, much higher than they currently are. But one of my slides showed that when you back out the Great Recession years, that's been missing our assumptions has been a contributing factor, but not nearly as large as missing other assumptions. And lowering that whenever they do that assumed rate of return, they take a lot of things into consideration. A lot of it is influenced by federal monetary policy. What are your interest rates going to be? What do you think inflation is going to be? And what is sort of the outlook of the capital markets in the future? So it's not as backward looking, it's more sort of forward looking. And it really depends a lot on what people's outlook of the future market is.
Corey, you were in that business for a while. Is 3 years looking back too long before you adjust that, or what do you think?
No, I mean, it's hard to do one or two. I think 3 is better than 5 just because you have the opportunity to get to it more often. I think that probably why we looked 5 further along is after 3 rough years, you probably have tough political decisions to make, like 08, 09, maybe 10. You know what I mean? But it does make a lot of sense. You want to be monitoring performance quite consistently.
Senator McCormick.
Thanks. I'm not a player, obviously, but what modest investments my wife and I have made over the same period, we've done pretty well. And I'm surprised why are our pension plans, why have they done so poorly? And part of that question is things were going pretty well, if I remember, nationally with the economy. In 2007, things were still going pretty well. Then you get the catastrophe in 08, and of course Obama inherits that, but that bottomed out in 09, to give credit mainly to the Federal Reserve, but also to Bush and Obama, who had the good sense to follow their advice. There were problems with the bailout, but it did seem to work. And then throughout the Obama and most of the Trump years, the country is in a slow, steady improvement. And it's really until COVID that things headed south. So why were our returns so disappointing in that context?
That's a great question. The simple answer is, pension funds, like a lot of other institutional investors, invest very differently than you or I would do. I'm 34 years old. I'm not going to need my modest retirement savings for a really long time. So I can put all my money in equities, in stocks, which, tend to have, over time, one of the stronger returns, but some of the most significant year-to-year volatility and risk. Yeah. And I can let it ride because I don't need that money to work for me. When you're up, and I can afford to have a couple years of negative returns because I have a long time horizon to make it back. When you're taking a look at a pension system, they're intentionally very diversified, where they don't put everything in domestic equities. They need to also put assets into things that protect you from inflation, protect you from downside risk, and things that are liquid, especially when you're paying out so many benefits right now, and things that sort of act as that ballast in the ship, if you will, that keeps you afloat when the waters get choppy. So there are times when you'll have asset classes that might be booming, might have 20+% returns. You'll also have some asset classes that might be in negative returns or single-digit returns, and every single year, who's highest and who's lowest in your asset class will change. So the goal, whenever the investment consultants are trying to build your investment portfolio, is what strategy can we put together to consistently hit that assumed rate of return over time? Because when you're putting so much out in benefits every year and your funded ratio is down in the 60s and 50s, you can't afford years of negative returns. Yeah. You can afford years of maybe 5% when you were hoping for 7%, but you need to really make sure that you're being conservative, and you tend to sacrifice risk and volatility in order to get that conservatism. So they invest a little differently than we do.
It looks to me like that is not what happened with the pension funds. You've described what I understand as conservative, lowercase c, conservative investing. And what you're doing is you're giving up the big kill in exchange for avoiding the catastrophe. that you're looking for something steadier and safer. So I'm still confused why would, and it looks like the performance of our investments were markedly worse than the economy as a whole. And I would expect that if we were taking crazy risks. But
Yeah, no, I think it's a really fair question. And the chair of VPIC is a great witness to invite in if you'd like to hear about this in more detail. I can tell you that pension systems nationwide, including the one that I came from in Philadelphia, and I think this was the case here too. You know, you go back 10 years, a lot of people invested money in, you know, what are called sort of alternative investments, things like hedge funds, things that aren't particularly liquid and tend to be high fee. A lot of plans, including here, have pulled out of those in recent years because they've realized that, you know, you tie up a lot of money that and you pay a lot of money in fees, and they don't always have a proven track record of beating passive investment. That's way less expensive. So I think, you know, this is not something that you can steer the ship completely in a different direction overnight. But I think the state has made some pretty significant steps at bringing more of their portfolio into less risky, lower cost investment vehicles. And we have seen the returns improve. Having said that, you know, you're absolutely right that, you know, the economy has done pretty well since the Great Recession domestically. You know, global events factor in too. Federal monetary policy and interest rates have an impact on things, especially when you look at sort of the fixed income market. Brexit has an impact. You know, things that happen in Europe and in the developing markets have a bigger impact in sort of domestic pension funds than they once did 30 or 40 years ago. So, you know, I think it's a combination of those factors. But if you want to hear more about the sort of investment strategy over the last few years, I would encourage you to reach out to the chair of VPIC, because I think he's got a lot of really interesting insights to share about the various steps they've taken in the last 4 or 5 years or so.
one last question, Mr. Chairman, and then I'll shut up.
Yeah.
You'd said that a defined contribution approach will not solve our present problem. But my understanding is going forward, it would at least not make it worse, as opposed to a defined benefit could.
Yeah, no, I think the benefit to a defined contribution plan for the employer is that you don't have the risk of an unfunded liability building up the way you do with the defined benefit. You know, you make your matching contribution to an employee's DC plan on sort of a pay-as-you-go basis, and then, you know, what happens in the market affects the employee. Then the employer is not necessarily on the hook to pay more or less. So, I mean, yeah, that is the advantage on the employer side of a DC plan. You know, it doesn't, however, do anything to address the hole that we're dealing with now, that unfunded liability. You know, that is due to the people who have been or are currently working. So that's why it won't do anything for that, but has impacts going forward.
And there is the small matter of breaking promises to people, making deals with people of what the terms of their employment are, and giving them the bad news that, well, maybe not. But just from purely, what's that?
Or go bankrupt.
Yeah, well, I'm saying, yeah, from the financial point of view,
The alternative's worse.
we're happier. The taxpayers are happier with defined contribution. I get that. Okay.
Or you had your hand up. I don't know if you still have a question or a comment.
Oh, yeah, I do. I don't know. My internet's been a little slow. Chris, you know, it's you know, no use to crying over spilt milk. But are we doing an analysis on the fees that we did pay for investments over the last 10 years so that we can memorialize it and never, you know, hopefully make the same mistake again?
That's a great question. I have not done any analysis on it. I can tell you that the fees are typically reported in the treasurer's on the treasurer's website under pension funds. They put their quarterly performance reports up, and you can see what the fees look like there. Generally, I think the last time I looked, the fees are like less than 0.1%. So, you know, in terms of the overall size of the funds, they're not particularly large. I've not gone back, 10 years, 10 plus years and compared them. Though I do think that would be an interesting exercise.
I just wonder, I'm on a pension, not a pension committee, but an endowment committee for my local hospital. And we just changed advisors really because, they were charging close to a point. And we were able, again, to go to a more passive investment strategy and save that, cost, if you will.
Yeah, and I wouldn't make, again, I'm not a licensed financial advisor or anything like that. I would caution that, what the right approach really varies by every different fund.
Right.
And there are some funds that are very comfortable putting all their money in sort of indexed passive funds at a really, really low fee. And there are some funds that are more comfortable having a more diversified strategy. I think there's a lot of factors that go into that decision. A lot of it's just, how does your fund behave? How mature is it? How liquid do you need your assets to be? And what's your tolerance for risk and volatility? It'll look real different if you're starting a new plan, or if you have a plan that doesn't have a lot of sort of drain on the money annually for benefit payments, as opposed to something that you can kind of set it and forget it, and you don't need to take a whole lot out of the portfolio. But having a laser-like focus on fees and making sure that you're not overpaying for performance is a really, really critical thing.
And then, one other piece that kind of pulled out of your presentation that I don't know if you can comment on, but since I was in middle school, I'm about your age, we're down 30,000 students. And had we had those 30,000 students in the classrooms, we'd have more teachers working, paying into the fund. Granted, somebody'd have more, but a lot of these built are on pyramid model population schemes where the population grows and not the other way around. And we're seeing the inverse of that. And is that accurate to assume that had we had a growing population and more workers, we potentially would be funding this?
Yeah, it's an interesting question. It kind of cuts both ways because, whenever you have more active employees, you also have more people who are likely to get a benefit in the future. I think the key point is, a really, really mature plan where you have more people drawing a benefit than you have actives paying in behaves a little differently than a newer plan. They don't turn around quite as quickly. Their tolerance for risk changes a lot. And that obviously impacts your investment strategy. One of the biggest things we've seen really impacting the plans goes back to demographic changes. And a big factor is net turnover. The prior assumptions thought a lot more teachers would be leaving the profession earlier in their careers. And it turns out way more teachers have stayed in the teaching profession and left upon retirement. So those factors, how that deviates from what you thought, are pretty significant contributors to how big the liability has grown. And actuarial tables have been updated. Public school teachers are among the longest lived demographic groups nationwide, according to the Society of Actuaries. And that's great. But whenever you've got life expectancies that are pushing 90, that does create strain on the pension fund that probably wasn't anticipated when these plans were first designed years ago.
That's good. Thank you.
Interesting comment. I'll have to think about that some more because my wife is a teacher and I don't know how I didn't anticipate she was going to outlive me by my life expectation, but that sounds interesting. Chris, I want to thank you for coming by. I suspect very strongly we're going to have you back in the future. In the beginning of each session, I try to bring the treasurer in to talk about how things are going, just to make sure we stay on top of where things are developing in the world of how we're going to get funded. But you've put together a really good presentation. I think you've given us some foundation talking points to talk about moving forward. So thanks for coming.
My pleasure.
Thanks, Chris.
Josh Hanford is now here. We're going to shift gears a tad bit. Josh, when I originally had you scheduled, I still would like to hear, hope you brought your PowerPoint presentation with you. But as far as I know, yesterday or the day before, the Appropriations Committee decided to take all the federal funds out of our bill and stick them someplace else. Not that that matters much to you, but I suspect at some point, some of that money will come back to us for spending on housing. And that's where you come in still to give us your presentation this afternoon, but the committee should be aware that the Appropriations Committee did remove Section 25 of the capital bill. And so when we go to have this conversation right now, we're just keeping our fingers crossed that money will come back to us in some form from the federal contribution, and we'll pick it up from there. So Josh, welcome to Senate Institutions.
Well, thank you for having me. Good afternoon. For the record, Josh Hanford, Commissioner of Vermont Department of Housing and Community Development. And yes, there was some changes in Senate approach yesterday that sort of guts part of this plan, but I don't think we're at the finish line yet. So if you will, I would just give you a high-level overview of the governor's housing proposal from the $1 billion of flexible state recovery ARPA funding, and sort of how that fits into some of the other proposals from the governor, and particularly the water and infrastructure proposal from A&R. There's a lot of overlap with some of the housing requests here. I think in the big picture, we all know how important housing, safe shelter has been for public safety, both personally and for communities. We've seen this with the over 2,000 households that are in motels and hotels. Our network reacted quickly and, housed people and really prevented an outbreak among the vulnerable population by taking that strategy. And that was a big benefit to us. But we have lasting challenges from those decisions. And not only that, our sort of relative safety during this pandemic has brought folks to Vermont, which is good. But it has driven up the home prices for working class Vermonters. I don't need to tell you all, if you look in the paper, look at your real estate listings, there is not a lot left for, working class Vermonters to become homeowners and purchase a home right now. The costs have gone up substantially. We're just not building enough of those sort of starter homes, homes that would be first time home buyer options. And so we really have the housing crisis hitting on both sides of this issue, both at the very low, vulnerable crisis housing situation, and then right up into our middle-class working families. So what the governor's proposal was is a historic investment in housing, $249 million, really with the goal of bringing on 5,000 units of housing by the end of 2024. Not all of these are new. This strategy includes building new housing where it's needed, rehabilitating distressed and underutilized properties in other parts of the state, transitioning the homeless to sustainable, safe housing that the state can afford long term. And why was there such a large investment in housing? One, we know that the ARPA funds have to be in response to problems caused by the pandemic. Building more housing, affordable housing, is a direct response to the pandemic. Housing was impacted greatly by the pandemic. We know it provides real solutions to sort of the demographic challenges, workforce challenges that Vermont was already facing and is going to continue to face in the future. And we know that housing construction, both new and rehabilitation, is instant economic stimulus. It has some of the best return on investments that you can measure. And when you're done, you have these assets that have lasting benefits for communities and multiple generations of Vermonters. So it's a really good investment to invest in our housing that's needed in our communities. And we know that additional housing stock will help stabilize housing costs and provide opportunity for Vermonters to build wealth. We also know that many of our communities have planned for growth. We have plans on the shelf in some of the areas that the state that are growing, housing projects that have, developers, the community, the planning community all bought into a project. They take years to plan and even more years to get all the various funding in place to to put them in motion. So we have folks that are ready to do this work. We have our communities, our affordable housing partners, our builders that are ready to sort of seize on this opportunity, form new public-private partnerships, and get this done. Other parts of the state that have housing stock that has sort of lacked investment over the years, there's parts of our state that have adequate housing stock. It's just not in good shape. It is, non-code compliant. It's vacant. We have studies that we know the most recent Vermont Housing Needs Assessment, which we have to do every 5 years to receive our federal funding from Department of Housing and Urban Development, has identified thousands of units. I think one of the numbers is 7,000 units. These are estimates. They don't have the exact address of all this, but 7,000 existing units of housing in Vermont that don't meet habitability standards. They are not, capable of housing people safely. So we have a chance to reinvest in some of this housing, not to mention repurposing buildings. Maybe, some office buildings are not going to be fully reoccupied. I know of 3 or 4 different school projects where, schools have consolidated and communities have empty school buildings that could be repurposed into great housing for folks. Not to mention some of the more immediate strategies dealing with some of the homeless population, where some folks are housed temporarily in motels and hotels. Some of those situations, not all of them, but some can transition to a permanent housing situation. It can be renovations. You can add kitchens. You can add separate rooms to some of those situations. Some of that work was done with CARES money last winter. Some of those options proved very successful and a quick way to provide permanent emergency housing solutions.
Hey, Josh, let me stop for just a second for logistics purposes. I have to leave in about 10 minutes or so to go join the House. So Dick McCormick, if you would carry on if I have to cut out. I'm hoping, Josh, you brought your PowerPoint presentation along with us. I don't know how long that takes to run, if you were planning on running it.
Sure. Well, I'd maybe have a different PowerPoint. What I have, what I'll throw up is a chart, which really shows, puts in numbers, what we're talking about here. I think that's probably the best thing to show. So if I can have screen share, I'm happy to share this one slide with you and talk through it. Okay. I also have a different slide that has some example projects, but to be honest, we've been criticized that those example projects are seeming like they're already pre-selected and that maybe hasn't been helpful. It was just meant to give some examples of the type of things we could fund, but I've been told maybe not to share that anymore. So if I can share screen, I'll share this chart.
Yeah, let me, while you're pulling that up, I need to tell the committee one other thing. We were planning on having the bill presented on the floor tomorrow, but since none of us that I know of yet have received our packets from Ledge Council, I'm going to ask that we have it passed over in order to prepare for that presentation. And just so you all know, I'm going to start the conversation. Russ, I'm going to hand it off to you. You are going to then hand it off to Senator Mazza. Senator Mazza is, no, I'm sorry, I take that back. Russ, you're going to hand it off to Dick McCormick.
Right.
Dick McCormick, you're going to hand it off to Dick Mazza. And then Dick Mazza, you're going to hand it off to Corey. And Corey is going to hand it back to me. But you guys each want to know who you're handing it off to, because you're going to yield the floor to that person coming up.
Is it written in the script we're getting? Is it written in there?
Well, there isn't any script at the moment, but I'm sounding like maybe we ought to have a script available.
Yes, I'll make sure you do.
Thank you. And Denise,
Joe,
if you can make sure that Becky has a summary for each of us, because thus far I haven't seen it and it was supposed to be coming to us last Friday.
Okay.
Yeah, Joe, thank you for that. I was feeling a little bit apprehensive.
We just, the secret to it all, Dick, is to just wing it and pretend you know exactly what you're talking about, and they'll all be totally convinced you're right.
And if it's
I've been
too
doing that all my life.
chair.
I've been doing that all my life.
We're going to muzzle through it somehow, but I do intend to get something from Becky. So Denise, if you can follow up on that and make sure we have that information, it'd be appreciated.
I'm
Which
doing it
one's
right
talking
now.
about sinking? Which one's talking about sinking the ship?
That'd be me.
Oh, good.
All right.
Can you see my screen? Can you see a chart?
Yes, we
Yes.
can. Thank you.
Okay. So this was developed with several of our partners, trying to address the needs of the sort of emergency housing situation, as well as these other middle income housing issues we're having. And really year one, focusing most of the funding on acute needs, trying to increase shelter capacity, rapidly deploy permanent housing for the homeless. One of the strategies here as well is to essentially, we can fund the entire affordable housing pipeline that we know of over the next 3 years, because this money can use as a soft source to fill in the gap. Those projects take years of planning and then many more years to raise the funding. We know of approximately 2,400 units of housing that's already planned for, in the works. These are in our designated downtowns and our, established growth centers and neighborhood development areas that have gone through a lot of pre-planning. And it would have taken 5 to 10 years to fund this full list. With this sort of resources, we could get at this in 3 years. It's both rehab and new construction, some home ownership, mobile home park investments, as well as also putting some money towards the farm worker housing issues that folks are hearing more about. So that's the line item that has 90 million in it, with a total of 2,434 units proposed. One of the other areas that we're really excited about is the VHIP, that's Vermont Housing Investment Program, where we partner with private owners of small properties and units that are offline or have code deficiencies. We reinvest in those properties with a small incentive. It's averaging about $22,000. We put about $7,000 of CRF money into this last year. And in 8 months, we brought 250 units back online. And those units, more than half of them directly serve homeless folks coming out of those hotels and motels. The landlord, that was a commitment to receive the state support, is to house folks in need with some ongoing, services and supports. So we want to continue that program. That's a good reinvestment strategy for our neighborhood, sort of bringing life back into them. And then the last one is the Home Builder Program. Sort of a new idea. It needs to be developed. We haven't really done this in Vermont, but what this is getting at is we have lacked what we're calling missing middle housing production for years. Since really the early 80s was the last time we were really producing enough supply to meet the demand for this sort of starter home ownership. We have a great system in place to build affordable housing, lots of partners involved in that work. And then, if you're wealthy enough to buy a home that comes online or have one built for you, you can find a home. But many folks in this middle just can't find something they can afford. And we're really afraid that, these folks that have been renters for years and feel like they've got good jobs, they should be able to be homeowners somewhere in Vermont. They're not going to wait forever. They're going to move someplace that they can find that homeownership dream elsewhere. And we don't want that to happen. We need to invest in the supply side. This is not a down payment assistance. We already have a program for that. This is to help encourage home builders to build homes at a price point that working class Vermonters can afford. Think about the governor's proposal to bring new, whether it's new refugees here, new Americans here. We have all these common goals, but we don't have the housing to support the folks we want to move to Vermont or Vermonters themselves. So that's what this is about. And what I'm, really sort of just a little concerned about is Senate appropriations. Their latest budget has taken out all of the elements of this that would address any of that middle income, market rate, home ownership, or rental opportunities for the future. And I think that sends the wrong message right now when we have this historic chance to build more housing, that we're not going to set anything aside to sort of address this, crisis in our housing market. and wait for future years to sort of work on these issues when we have the ARPA dollars now to put towards this. From what I saw, the latest approach was only 17 million of ARPA money for housing in year one, when the governor's proposal dedicates 129 million to housing out of ARPA funds in year one. So, I think maybe with the short time, maybe questions would be better way to go from here.
That's fine. Committee, questions, comments, thoughts? I don't hear anybody screaming right now. Josh, you may have gone through your presentation quicker than you had imagined.
I guess so.
The conversation is obviously going to continue. I think that what APROPS did, well, APROPS is the committee of God, so to speak, so they can do whatever they want as far as money is concerned. But the conversation about housing moving forward is eventually going to get a little bit more heated. And of course, you're going to have to wrestle with that and what monies are actually available and what strings they come attached with. But right now, this committee is trying to get a 50,000 foot view of the picture in the event that some of this money comes our way and we have to start making decisions on how we want to spend things. Having said that, Senator McCormick, you have your hand up. And you're muted, Dick.
Sorry. Yeah, this was not part of what you talked about, but it's related, I think. Do we have any, what are your thoughts on landlords, in particular, small scale landlords, mom and pop with just a few rental units, who have not been collecting rent for the last year? Any way of making them whole?
Yeah, there's a lot to unpack there. Certainly this VHIP program, where the majority of folks that receive funding from our sort of CARES Act pilot of this were smaller scale landlords, but they were really doing rehab work on their homes. That's not going to be the same as sort of the loss relief from their business as property owners that haven't been paid. The rental assistance that is available is supposed to be that source. So just as a recap of CRF money, last winter, we stood up an emergency program, 25 million of CARES funding, one of the few states that did that paid for rental arrearages. We got to make up our own rules. We made a really simple, easy program. We went through all the funding. December of this last year, December 27th, that rescue plan was passed. It brought $200 million to Vermont for rental and utility assistance, both arrears and going forward up to 15 months. That program came with a lot more rules. It was a national program. You had to prove eligibility, number of steps, and the tenant has to participate. The program we ran with CARES funding allowed a landlord that didn't have a tenant that was willing to participate to at least receive some back rent to cover their losses. These new federal programs don't allow that. They require the tenant personal information to participate. And this is presenting a real challenge. That program was just launched a few weeks ago by the Vermont State Housing Authority. That's our partner. They're the state quasi-agency that delivers rental vouchers on an ongoing basis to many landlords and tenants. So they're the go-to for this work. It's been a real challenge with these new rules. In addition to those federal rules, the legislature added a few additional rules on top of those. So it's not as flexible of a program. And I'm hearing many stories of landlords that either can't get their tenant to participate or is unwilling. But that is their only recourse, is to get them to participate, receive some back rent, because the eviction moratorium is still in place at this point. I will note that the federal eviction moratorium, which ends the end of June, allows for a provision that says if you're eligible for assistance, such as this rental assistance, and you refuse to participate, eviction can proceed. Vermont's current eviction moratorium does not allow for that. It's interesting because this very topic is being discussed right now in House General. But that is one of our few ways to solve this problem, is to put some exceptions in the eviction moratorium that says if you have the ability to pay or you're eligible to receive rental assistance, you must participate in that, or your eviction moratorium is no longer in place under those conditions. I think that's something that needs to be talked about more.
That's pending legislation?
Well, I don't know that they're going to take it up. They're discussing it right now. The Vermont Landlords Association has proposed a few fixes to the existing eviction moratorium, which was it's Act 101 of last year. They're proposing this as one of the changes that they would like made to help address these situations. And they're trying to work out an agreement with Vermont Legal Aid on just exactly how far they're willing to go on a compromise.
You know, it's dismaying how one problem spills into another. Given the gravity of COVID, I think shutting down the economy was necessary. Given that, the eviction moratorium was necessary because there are people who couldn't pay their rent and it wasn't their fault. But letting the landlord hold the bag, it strikes me as just unfair. Why would we stop there? You know?
Right. I think that you're bringing up, the eviction moratorium was put in place for public health. There's no doubt that we needed to do that. It was put there for reasons, not have people kicked out, doubling up, moving into shelters. But at this point, landlords are being treated separately than any other business in the state. They are being told you need to provide this for free for public health. But they're not being, sort of awarded assistance, economic assistance grants, because there's literally $352 million for Vermont just to pay rent. And so that's their source. But there's this nuance there of the eviction moratorium that may be acting as a disincentive to have those tenants apply for these funds.
Well, and honestly, the rollout was slow. I own a few units and have a couple tenants. One, I can't get a hold of, so I'm not holding my breath on that money. So I'm in that boat. And two, I have a tenant who was approved for the other stuff but hadn't paid since January, and I still haven't got my money. So we're looking at May 1st. I paid water bills for them. I've paid taxes all that time. I've paid my mortgage. And I'm a small operation that, I have 8 units, but you're talking, we ate $7,000 or $8,000 over the last few months. That's all of our profits, in all honesty, and then some.
Absolutely.
So it is tougher. I have no doubt.
I've spent my career fighting for the tenants. I'm a champion of the little guy, but you know what? Fair is fair. It sounds like the landlords are getting a rotten deal.
I think.
Yeah, I mean, if you go into a credit line to borrow the money, I haven't, but I know some who've had to go into credit lines. They're not even getting repaid the interest. They can't charge a penalty. They're still losing out on those costs. I had to put 20 some odd thousand, last year was a thing. I redid a unit that cost $20,000. So you add that on top of these other things, and you're sitting there going, well, at least property values are going up, because that's the only positive I have right now is if I sell it.
Yeah,
I really hope that this experience doesn't have lots of landlords just moving out of this market. We already know that short-term rentals is one way to sort of, have more income produced, less of the landlord-tenant law. And this experience, unfortunately, might drive more people to do that. And it's going to hurt our housing. Even more reason why we need more dollars to invest in housing, supply issues right now.
What I worry about is the inflationary impact on rents. We're already seeing the issue, but I can tell you, because we've had to eat these costs the last couple of years, as soon as you get an opportunity to touch rents, rents are up a couple $100 just in St. Albans. And, I can't touch them because of this program, but as soon as you can, you will. Because you got to make back the money some place, and that goes there. And so you're going to see I mean, we have a development project where they just built 31 units in St. Albans. One bedroom's going for $1,600 a month. So that makes a 2-bedroom at 14 look pretty cheap. You know, we're charging $1,200 now. So you're going to see this rapid inflation in rental prices. I think part of all of this too.
Yeah.
Do you have any suggestions for us, what we can do with?
Yeah, I mean, I'm happy to share with you the language that Vermont Legal Aid has put together to address most of these problems. Like I said, it's an exemption if you have the ability to pay and you're just choosing not to, or you are deemed eligible for this relief, this rent relief, and you're choosing not to participate. Those are the two things that address this problem, as well as they're also proposing a couple other eviction exemptions related to sale of property. If you yourself need to move back into your own property or you need to sell it, you know, some people are unsure about the piece just to outright sell it because someone, you know, trying to take advantage of the hot market and sell it. Well, you're still displacing someone. So that's a little bit debated, but there's a few cases where folks actually that own the property are homeless or in jeopardy of housing themselves because they were gone, they rented their home, they've come back to Vermont, they can't reoccupy their home, and so they're living in a trailer all winter or there. And so it's really tough. And, you know, only two solutions are to, in my view, update the eviction moratorium, because the eviction moratorium, just as a reminder, is connected to the governor's emergency order. That's the law that was passed, Act 101, and it extends it 30 days past the expiration of the governor's emergency order. So let's say the governor ends the emergency order in July. It's still going to go to August before this is resolved if we don't have some updates to the Eviction Moratorium Act 101. And
then you got to get through the courts. I mean, you're not getting anyone out until next summer anyway. In all honesty, you're eating another year. You know, and the housing piece is similar. You know, this is Senator McCormick Yale. Probably this is a real example. I have a constituent who bought a house before COVID, was in the process of selling his house, but he, you know, it took a while. So he rented out the house he had bought, sold his house. They can't get the people to move out. So he's been renting the last 16 months, waiting to move into his new house.
Gotcha.
So yeah. So it's just we have these stories all over the place.
Yeah.
So
it's tough.
So the part that you want to share with us may or may not happen, right? As far as the new rules, as far as the tenants don't have to initiate it. It can be initiated by the landlord. And if the tenants have the ability to pay and they choose not to pay, that hasn't been decided yet. Is that correct?
Correct. House General is discussing it. They've had a few testimony sessions on this. They're doing it right now. I've so far not heard Senate Economic Development Housing, Policy Committee take this up. So, you may want to talk to a few of your colleagues on that committee if you're hearing from your constituents about this challenge, to have them take some testimony on this, because it's not something that I can't affect it. I can't help, it has to go through legislation to make a change here, or the governor's emergency order needs to end.
Yeah, that's not happening this year. I'll tell you that. It's unfortunately. As far as not the governors, but as far as the first part of my question, I don't see that. I don't see them agreeing to that in time.
What they're considering is there's a bill right now in House General S79. It deals with the rental registry and the additional money to help landlords with repairs going forward. There's some discussion about maybe this fix gets attached to that, and because it's got to go back to the Senate because it was changed. I don't know. I'm hearing that as maybe a vehicle to do this, but whether there's the appetite for it or not, I couldn't tell you.
And well, there's problems with S79 as well, especially on the short-term rental part of it, because if the government guarantees payment and somebody refuses that and makes one misstatement about, well, that's not really who I intended to rent to, well, then they're in violation of civil rights and human rights and all of that. So that's a whole nother issue that's going to spawn a bunch of lawsuits and people getting in trouble that weren't meant to be in trouble or intended to be in trouble. But that's neither here nor there. So it is, as it was said earlier, it's, by Senator McCormick, it's funny just how one problem spawns into a bunch of others, and that's where we're at.
Yeah.
Any other questions or comments from the committee? Denise, to avoid my background noise interfering, I left my laptop, so I don't have the agenda in front of me. Do we have anything more for this afternoon?
No, we do not.
We're done.
Yep.
Are we done?
We are.
Okay, I guess we're done. Then we'll adjourn. Thank you.
Thank you. Thank you.
Yes, very much,
Thank you.
Josh. Thank you.
Thank you,
Thanks,
committee.
Josh.
Thank you. Good to see you, Denise.
See you tomorrow.
Thank you, everybody.
Bye-bye.
Yep. Come on. Jeez.